Welcome to the deep dive. Before we jump in, make sure you hit like and subscribe on the Stock Analytics AI YouTube channel.
Absolutely.
And just a quick reminder for everyone, for only $4.99 a month, our members get priority for deep dives on the stocks they really care about. Suggest them right in the comments.
It's a great way to get tailored analysis.
Today we're digging into Enphase Energy Inc. That's ticker ENPH. Now this is a name that, well, it used to be almost synonymous with solar innovation, right?
Yeah, a real pioneer.
But lately, things have taken a sharp turn. The stock's down, something like 70% over the last year, hit new 52-week lows.
It's been a brutal ride for shareholders, no question.
So the big question we want to tackle today is this massive drop, this current pain for Enphase, actually an opportunity for investors, a potential gain?
Yeah.
Or, is there more trouble lurking?
Exactly. Our mission today is to unpack the fundamental strengths and, frankly, the profound risks facing Enphase. We need to figure out if there's a genuine margin of safety at this, well, deeply depressed valuation. We're working from a comprehensive deep dive analysis report on the company, and we'll be sticking strictly to what that report tells us.
Great. So to really get our heads around this, we need to peel back the layers. We've structured this deep dive into two main parts.
Makes sense.
In part one, we'll dive into the company's core business, take a look at the management, and scrutinize the financials, the real nuts and bolts.
It's fundamentals.
Then in part two, we'll shift gears. We'll look at market sentiment, what's Wall Street saying, who actually owns the stock, what are the big risks, and then, of course, we'll try to reach a verdict on its value.
Sounds like a solid plan. Let's get into it.
All right, let's kick off part one, business, management, and financials. Okay, let's start with chapter one, business analysis, the engine of innovation under a clouded sky. Our report really frames the situation well with this question. Having pioneered the microinverter and built a dominant home energy ecosystem, Enphase Energy now faces a perfect storm of collapsing demand, policy whiplash, and punitive tariffs. Can the company's technological moat withstand the cyclical tempest, or will the very forces that propelled its ascent now trigger its decline?
Wow, that really sets the stage, doesn't it? High stakes.
Definitely. And just for clarity, this analysis focuses on Enphase Energy, NASDAQ Q2, ENPH, based on the market close of June 17, 2025.
Right. So fundamentally, Enphase uses a fabless manufacturing model. It's kind of like how Apple operates. They keep all the crucial R&D and design work in-house, mostly at their California headquarters, but the actual making of the hardware, the microinverters, the batteries, that's outsourced.
Two partners like Flex and Salcomp.
Exactly. Flex Ltd, Salcomp, those guys. This makes Enphase really agile, asset-light. They can scale up or down without massive factory investments.
But the downside?
The downside is dependency. They're tied to the global supply chain. If there are disruptions, material shortages, tariffs, it hits them directly. And as we'll see, that's become a very real issue.
That makes sense. And looking at their revenue streams, it feels like there's been a strategic shift. Microinverter systems and components are still the biggest piece, like 75% of FY 2024 revenue.
Still the core, yeah.
But IQ battery storage systems are now around 20%. That seems like a big jump, a real growth driver.
It absolutely is. It's crucial. And then you have software and services, like the Enlighten monitoring platform. Smaller revenue now, but strategically vital for building those long-term recurring relationships with homeowners.
Plus the IQ EV chargers they got from buying ClipperCrate.
Right. So what you're seeing is a deliberate move away from just selling hardware.
Towards becoming an integrated energy management company.
Precisely. They want to manage the whole home's energy. It's about building an ecosystem.
So tell us more about the key products in that ecosystem.
Well, the cornerstone is still the IQ microinverters. Their big advantage over traditional string inverters is that they work on each panel individually.
Right, so one shaded panel doesn't drag down the whole system.
Exactly. Maximizes energy harvest. Plus, it's safer, no high-voltage DC running across your roof. And the IQ8 series, that's a real innovation. It has grid-forming tech.
Meaning it can provide backup power even without a battery.
You got it. During an outage, it can create its own mini-grid just using the solar panels. That's a huge selling point. Then there's the IQ battery, the latest being the IQ Battery 5P. That's for energy storage independence from the grid.
It all ties together.
Yeah, through the Enphase Energy system and the Enphase app. The IQ gateway is the brain connecting to the cloud. Homeowners get real-time monitoring, diagnostics, and increasingly AI features to optimize how they use energy. And the IQ EV chargers integrate right into that system too.
Okay, so they've built this comprehensive system, and the scale is impressive. 81.5 million microinverters, 4.8 million systems, 160 plus countries.
They're the global leader in microinverter systems, no doubt. Dominant in what's called MLPE, module-level power electronics. About 45% global share.
Ahead of SolarEdge.
Ahead of SolarEdge, yeah. Especially strong in the U.S. residential market.
That 70% stock drop, it still feels like a disconnect between that market leadership and the market's current valuation.
The disconnect is the current environment, brutal industry headwinds. But the core value proposition for both homeowners and installers, that remains strong, which is key for any potential recovery.
So for homeowners, it's higher production, lower bills, safety, independence, that user-friendly app.
Right, and for installers, it's efficiency. Simpler design, faster installs, fewer service calls, truck rolls, because the stuff is reliable, and they can diagnose issues remotely.
So the bigger picture here is turning a simple sale into a long-term relationship, driven by software and energy management.
Exactly. That's how they build that defensible moat. It's sticky.
Okay, let's zoom out a bit to the industry analysis. The market trends are definitely looking tough right now.
Yeah, global solar growth is slowing down. Forecast is maybe 10% for 2025. And the U.S. residential market specifically is actually contracting.
Declined in 2024, expected to decline further in 2025. Yeah. Maybe stabilization in 26 to 30. That's quite a wait.
It is. And the headwinds are clear. High interest rates are poison for solar loans, making it much more expensive for homeowners. That kills demand.
And policy changes, like California's NEM 3.0.
Huge impact. Slashing the compensation homeowners get for sending excess power back to the grid by 75%. That fundamentally changed the economics in a key market.
Ouch.
But, and this is where it gets really interesting, despite these headwinds, the long-term growth drivers are still there.
You mean things like rising electricity prices, the push for clean energy?
Exactly. Grid resilience is becoming a bigger deal too. And energy storage, EVs, those trends aren't going away. And crucially, look at battery storage attachment rates.
The percentage of new solar installs that also include a battery.
Right. It surged from under 12% in 2023 to over 28% in 2024. That's a massive tailwind, specifically for Enphase's ecosystem strategy, even if overall solar installs slow down.
That's a key point. What about the competitive landscape? Who are they up against?
Their main rival is definitely SolarEdge, SEDG. They have about 40% MLPE share, using power optimizers instead of microinverters.
Slightly different tech, similar goal.
Kinda. Then you got traditional string inverter guys like SMA Solar, Huawei, and increasingly low-cost competitors are emerging, like Dai, Ape Systems.
And the big ecosystem players.
Right, like Tesla Energy with their Powerwall. They offer the whole integrated package too. It's a crowded field.
And the regulatory environment sounds like a minefield.
Highly volatile. It's a major risk. Federally, the big one is the Solar Investment Tax Credit, ITC. Its future is really uncertain.
Proposed cuts by 2026, maybe eliminated by 2028. That sounds like it could crush the stock.
It absolutely could. It was a trigger for recent sell-offs. Then at the state level, you have those net energy metering NEM rules, like NEM 3.0. Each state is different. Plus, all the industry codes and standards they have to keep up with.
So with all these challenges, what are the barriers to entry protecting Enphase? It sounds tough to get into this market.
It is. First, technological expertise and IP. They have over 300 active patents. That's hard to replicate.
Okay.
Second, brand reputation and their installer network. They're seen as a premium, reliable brand. And installers who are trained on Enphase face real switching costs if they want to move to another system.
Training, inventory, workflow changes.
Yeah. Plus, you just need significant capital and scale to compete globally. And you need the know-how to navigate that tricky regulatory landscape we just talked about.
So, summing up their competitive advantages.
I'd say strong brand strength allowing premium pricing, cost advantages from the fabless model and scale, powerful network effects and switching costs that installer network, and the growing homeowner platform effect with the integrated app for solar, battery, EV, AI. That ecosystem is key.
It becomes harder to leave once you're in.
Exactly. That's the moat. And finally, their unique assets capabilities, pioneering the microinverter, that unique IQ8 grid-forming feature, and just the proven ability to design and integrate a complete working system.
Okay, that paints a clear picture of the business itself. Let's shift focus. Especially in tough times, leadership is critical. Let's move to Chapter 2, Management Evaluation, Stewardship in Turbulent Times.
Absolutely crucial.
The CEO is Badri Kothandaraman. He's been in charge since 2017, came from a semiconductor background. What's his track record look like?
Well, it's kind of a tale of two crises. His 2017-2018 turnaround was frankly remarkable. Enphase was in deep trouble, facing an existential threat. Oh, yeah. He came in, focused ruthlessly on efficiency, cut costs, drove the innovation for the IQ series, and pulled them back from the brink. A huge success, showed real operational skill.
But the current downturn, 2023, 2025, that's different.
Very different. This crisis is largely external. High interest rates, policy headwinds, that inventory glut across the industry. It's not primarily an internal operational issue like before.
So management's response?
Cost-cutting again, 500 layoffs announced. They terminated a manufacturing contract. And they're attempting this complex, expensive shift of battery cell manufacturing from China to the U.S. because of potential tariffs.
Trying to mitigate that geopolitical risk.
Right. So the big test now is whether that internal operational brilliance Badri showed before can translate into navigating these external macroeconomic storms. It's a different challenge. We should also mention co-founder Raghu Belur is still there as Chief Products Officer, which adds stability on the tech side.
What about communication transparency? How open are they with investors?
Generally, pretty standard. Regular quarterly reports, conference calls, CEO letters, webcasts for the annual meeting, the usual channels.
But there's an issue.
There is a significant blemish, yes. There are ongoing securities, class action lawsuits, and shareholder derivative lawsuits.
Alleging what?
Alleging false or misleading statements were made by the company or executives. Now, these are allegations, not proven facts, but their existence is a material governance risk. It raises questions and could potentially lead to fines or settlements.
Okay. Well, let's talk capital allocation. Where are they putting their money?
Well, they consistently invest heavily in their core business, R&D, like $108.3 million in FY 2023, which was over 17% of revenue. That's substantial, focused on next-gen tech.
And acquisitions.
Their M&A strategy seems focused on bolt-ons. Smaller deals to enhance the ecosystem, like buying Clipper Creek for EV charging, or software companies like Sofdesk and 365 Pronto. Not huge, company-transforming deals.
What about returning cash to shareholders?
Dividends, buybacks, no dividend. They reinvest for growth. But they did authorize a $1.0 billion share repurchase program back in July 2023.
Have they used it much?
They bought back about $192 million worth through the first 9 months of 2024, with almost $100 million of that in Q2 2024 alone.
Okay, so they're buying back stock while the price is falling, the timing and price. Does that raise questions given the downturn?
It absolutely does, and it leads directly to a critical point.
Yeah.
Return on invested capital, ROIC. This metric tells us how effectively management is using capital to generate profits.
And how does Enphase look there?
Historically, very strong. ROIC was excellent, 42.8% in 2022, 33.3% in 2023. They were generating great returns.
But recently?
Annualized ROIC in Q1 2025 was only 5.75%. The trailing 12-month TTM figure is 9.28%.
Okay, down sharply. But is that good or bad relative to their cost of capital?
That's the crucial comparison. Their estimated weighted average cost of capital, WACC. Basically, the return investors expect for the risk involved is 10.21%.
Uh-oh. So TTM ROIC at 9.28% is below their WACC of 10.21%.
Precisely. And this is a major red flag. It means, based on the last 12 months, the company is actually destroying shareholder value with its growth investments. Every dollar invested is currently generating a return less than the cost of that capital.
Wow. That fundamentally changes the picture, doesn't it? Especially when they're also spending cash on share buybacks?
It creates a significant contradiction. Why buy back shares if your ongoing investments aren't clearing the hurdle rate? It raises serious questions about capital allocation strategy in this current environment.
Definitely something to watch closely. Okay, this leads us right into the numbers. Let's tackle Chapter 3, Financial Analysis, a tale of past growth and present pain.
Yeah, the financials really tell the story here. It's dramatic.
Let's start with some key metrics. Market cap.
Around $6.1 to $6.1 billion as of mid-June 2025, which sounds big, but you have to remember where it came from.
Down from almost $340 per share peak in late 2022, and even $9.9 billion market cap just a year ago.
A catastrophic decline. No other way to put it. And the revenue growth trends. The 5-year average looks okay at 14%, CAGR but that hides a lot.
A lot of volatility. You had insane hypergrowth in 2021 and 2022, like plus 78% and plus 69%.
Wow.
Then boom, a reversal, down 1.7% in 2023, and then a collapse in FY 2024, down almost 42% to $1.33 billion.
And Q1 2025.
Q1 2025 revenue was $356 million. Now, that was up 35% compared to Q1 2024, which was a very weak quarter. But importantly, it was down 7% sequentially from Q4 2024. So the recovery isn't exactly smooth sailing yet.
What about profit margins? Gross, operating, net?
This is actually a relative bright spot. Gross margin has held up surprisingly well, 47.3% in FY 2024, still 47.25% UDAP in Q1 2025. That suggests they still have pricing power on their core products, a sign of that competitive advantage.
But further down the income statement.
That's where the pressure shows. Operating margin has compressed significantly. TTM is now 10.7%, way down from 20% in 2023. And net margin followed suit, TTM 10.4%, down from almost 20%. The revenue drop and potentially higher operating costs are hitting the bottom line. And free cash flow FCF generation. Cash is king, especially in a downturn.
Absolutely. And FCF followed that boom-bust cycle. Almost $700 million in 2022.
Right.
Declined to $480 million in 2024. And Q1 2025, only $33.8 million generated.
That's a huge drop. Must impact their flexibility.
It's a significant concern, yeah. Less cash means less cushion, less ability to invest or buy back shares without potentially taking on more debt.
Let's look at financial stability. Earnings consistency. Sounds like it's been shaky.
Highly volatile.
Yeah.
EPS went from $3.22 in 2023 down to just 76 cents in 2024.
Yeah.
And they've missed analyst consensus estimates in 3 of the last 4 quarters. Hard to predict.
What about debt? Debt to equity ratio.
Reported around 1.44 to 1.49, which is generally considered higher than the industry average. If you compare their total debt of $1.2 billion to their current market cap, it's around 22%. This is definitely a key metric to monitor, especially with cash flow weakening.
But their short-term liquidity looks okay. Current ratio.
Very strong, actually. Ranged from 1.9 up to over 4 recently. That means they have plenty of current assets to cover their short-term liabilities. That's a crucial buffer right now.
Okay. And dividend stability is not applicable since they don't pay one.
Correct.
So let's get into valuation analysis. How does it look compared to peers or its own history?
It's a really mixed bag. The relative valuation picture is complex. The trailing PE ratio is still quite high, anywhere from 36 to 62, depending on the source and exact period. That's richer than the S&P 500's 26.4.
So still looks expensive on earnings.
Trailing earnings, yes. But look at price to sales. It's around 3.8x to 4.2x now. That's way below its 2-year average of 7.3x.
Suggesting it might be cheap relative to its historical sales multiple.
Exactly. And price to free cash flow is around 10.6x, which looks pretty favorable compared to the S&P 500's 20.5x. So different metrics tell different stories.
Which is why we need an intrinsic valuation, like a DCF.
Precisely. A discounted cash flow analysis is fundamental for value investing. You forecast the future free cash flows the business is likely to generate, say, over 5-10 years. Then you estimate a terminal value for the cash flows beyond that.
And discount it all back to today's value.
Using that weighted average cost of capital, or WACC, as a discount rate, it accounts for the time value of money and the riskiness of those future cash flows.
So what does the educational DCF model in our report suggest for Enphase?
Factoring in all the current uncertainty, the model estimates an intrinsic value range of $45 to $65 per share.
With a base case estimate of?
$55 per share.
Okay. And what are the key assumptions driving that DCF model?
The discount rate, WACC, is relatively high at 10.21%. That reflects the volatility and the industry risks we've discussed.
Makes sense.
We used a 10-year forecast period. For the short-term growth rate, years 1 to 5, the base case assumes 7% growth. The bear case is just 2%, and the bull case is 12%. So quite a range reflecting the uncertainty.
And the long-term growth rate after that?
A conservative perpetual growth rate of 3.0%. Standard practice, usually linked to long-term economic growth.
Okay, that wraps up part 1. We've covered the business, management, and the tough financial picture.
Yeah, a lot to digest there.
Now let's move into part 2 of our deep dive. Here we'll explore market sentiment, ownership structures, the critical risks, and bring it all together for a conclusion.
Right. This is where things get really interesting as we look at Chapter 4, market sentiment, gauging the Wall Street narrative. How is the market actually perceiving Enphase right now?
Well, if you look at market perception from analysts, it's, let's say, conflicted. The consensus rating is basically a shrug. hold.
Not exactly a ringing endorsement.
Not at all. Out of 33 analysts covering the stock, it's almost perfectly split. 12 buy ratings, 10 holds, and 11 sells.
Wow, that's divided. What about price targets?
The 12-month price target range is incredibly wide. Like, the low end is around 31, 33 three-lers, and the high end goes up to $84, $125.
That's a huge range. What does the average say? The average target is somewhere between $52 and $59. But, and this is important, that average has been steadily declining. So it feels more like a lagging indicator, analysts catching up to the falling price, rather than predicting a rebound.
And the recent news impact sounds like it's been mostly bad news driving the price.
Decidedly and powerfully negative, yeah. That proposed U.S. federal legislation to cut or kill the Solar Investment Tax Credit, ITC. That caused a massive single-day drop, over 25%.
Ouch.
And that was piled on top of analyst downgrades from big names like Barclays, BMO Capital, BNP Paribas. The general media tone is pretty bearish too, focusing on those 52-week lows.
Okay, let's look at some specific market indicators. Short interest. That tells us how many people are betting against the stock.
It's extremely high. Depending on the source, it's somewhere between 19% and 25% of the float.
Wow, compared to the peer group average of around 8%.
Exactly. It's significantly elevated. The days to cover is around 4 or 5 days.
Meaning it would take short sellers 4 or 5 days of average trading volume to buy back all their borrowed shares.
Right. Now, that's a strong bearish signal. Lots of people betting the price will fall further. But it also creates the potential fuel for a short squeeze.
If good news hits and shorts rush to cover their positions, driving the price up sharply.
Precisely. It adds another layer of volatility.
And technically looking at price relative to moving averages.
It confirms the strong downtrend. The stock is trading significantly below its 50-day moving average, which is hovering around $46, $47. And it's dramatically below its 200-day moving average, which is up around $58, $70.
So clear technical weakness on top of the negative sentiment.
Yeah, major technical damage has been done.
Yeah.
It needs to overcome those levels to signal any kind of trend change.
So with all this negativity swirling, who actually owns the stock? Let's dig into Chapter 5, ownership structure. Who holds the reins?
Okay, stakeholder analysis. Looking at top institutional ownership patterns, it's actually very high. Institutions own somewhere between 72% and 94% of the company.
Yeah, the big players?
The usual suspects. Vanguard holds over 12%, BlackRock has about 10%, State Street around 3.8%.
So the big index funds and asset managers, are they buying or selling?
Well, that's where it gets interesting again. In Q1 2025, more institutions actually decreased their positions, 369 firms, then increased them, 294 firms.
So net selling pressure from institutions overall.
Seems like it. Vanguard and BlackRock trimmed their holdings slightly. But on the other hand, some active managers like Bailey Gifford and Invesco made significant additions.
So a real divergence of opinion among the smart money. Some getting out, some seeing opportunity.
Exactly. No clear consensus there either.
What about insider holdings and recent transactions? Are executives buying the dip?
Insider holdings are pretty low overall, around 3% to 3.5%. There was one positive signal recently. CEO Badri Kothandaraman did buy 4,000 shares on the open market in late April 2025, spent about $185,000.
Okay, a vote of confidence from the CEO.
Yes, but it's kind of overshadowed by the selling. In the prior 3 months, insiders sold about $6.2 million worth of stock.
Whoa, mostly who?
The vast majority was one director, Thurman J. Rogers, who sold about $6.1 million worth. The CFO, Mandy Yang, also sold a smaller amount.
So one small buy versus significant selling, on balance.
On balance, the signal from recent insider transactions looks net negative.
And overall ownership concentration.
It's moderately concentrated. The top 10 institutions hold a significant chunk. The Herfindahl-Hirschman Index, HHI, is 5.17, which indicates moderate concentration.
Meaning those top holders have considerable influence.
They do. Their decisions to buy or sell can definitely move the needle on the stock price.
Okay, let's pull back and look at the bigger strategic picture with the SWOT analysis. We're now in Chapter 6, Risk Assessment, a comprehensive SWOT and threat analysis.
Right, the SWOT gives us that balanced view. Let's break it down.
Start with the strengths.
Technological leadership is key. The microinverters, the unique IQ8 tech, the integrated home energy ecosystem they've built, strong brand recognition, and that loyal installer network. And the asset-light, fabless business model gives them flexibility. Plus, despite recent pressure, the balance sheet still has strengths like that high current ratio.
Okay, now the weaknesses.
High dependence on the residential solar market. When it slows, they feel it acutely. Their premium pricing strategy can be a vulnerability in downturns or against low-cost rivals. The fabless model creates supply chain risks. And critically, that negative ROIC-WACC spread we discussed, the fact that they're currently destroying value with growth, is a major weakness.
What about opportunities looking ahead?
Huge potential in international market expansion where solar penetration is lower. Continued growth in energy storage and EVs is a direct tailwind for their ecosystem. Developing more AI-driven energy management services and potential partnerships with utilities could open new channels.
And finally, the threats. These seem very real right now.
They are. Intense competition, not just from SolarEdge, but also Tesla and emerging players. Adverse regulatory or policy changes, the ITC threat is prime example. Macroeconomic headwinds, especially high interest rates, and significant geopolitical risk, particularly around trade and tariffs.
Let's focus on those immediate external threats, the impact of macroeconomic factors.
High interest rates are public enemy number one for residential solar right now. They just kill the affordability for homeowners needing loans. It's a primary driver of the current slump.
And inflation.
That puts pressure on their costs, materials, components, labor squeezing those gross margins, even though they've held up relatively well so far.
And the impact of geopolitical factors. You mentioned tariffs.
Yes, this is a new and specific threat that emerged in April 2025. The U.S. imposed potentially steep anti-dumping and countervailing duties on solar cells and modules coming from key Southeast Asian countries: Cambodia, Malaysia, Thailand, Vietnam.
Where Enphase gets a lot of its components manufactured.
Exactly. Because of their fabless model, this directly impacts their cost of goods sold and profitability. Management has explicitly warned about a negative impact on margins.
In trying to shift production, like battery cells, to the U.S.
It's complex, costly, and takes time. So that tariff issue is a major near-term threat to their financial performance.
Okay, we've covered a lot of ground. Strengths, weaknesses, opportunities, and some very significant threats. This brings us to the big question, the bottom line. Let's wrap up with Chapter 7, conclusion, the verdict on value.
All right, let's synthesize everything. What are the competing arguments here?
Lay out the bull case first. Why might someone invest in Enphase now?
The bulls would argue, 1, there's still a dominant innovator with a real technological moat, especially microinverters and IQ8. 2, they've built a superior and sticky ecosystem with high switching costs. 3, they operate in a massive long-term total addressable market, TAM, driven by decarbonization and electrification. And 4, with the stock absolutely decimated, there's a potential valuation opportunity. It looks cheap on metrics like price to sales compared to its history.
Okay, compelling points for the long term. Now, the bear case. Why stay away?
The bears point to 1, severe cyclical and policy risk. High rates are hurting now, and the threat to the federal ITC is credible and potentially devastating. 2, intensifying competition and the resulting margin pressure. 3, that specific geopolitical supply chain threat from the new U.S. tariffs on Southeast Asia. And 4, perhaps most fundamentally right now, the current negative value creation, the fact that ROIC is below WACC, meaning growth is currently destroying shareholder value.
So bringing it back to the valuation summary from the DCF model.
Right, our educational discounted cash flow model, which tries to account for all this near-term uncertainty, estimated an intrinsic value range of $45 to $65 per share with a base case of $55.
And the stock is currently trading around $35.21.
Correct. As of June 17, 2025, it's trading below the low end of our estimated intrinsic value range.
Which presents, as you said earlier, a classic dilemma for value investors.
It really does. So the concluding outlook is this. For an investor with a high tolerance for risk, a multi-year investment horizon, and strong conviction that these current headwinds are truly temporary, well, the current price could offer a compelling margin of safety. You'd be betting on the long-term secular trends winning out.
But for the more conservative investor?
For a more conservative investor, the tangible risks look pretty daunting right now. The adverse U.S. trade and energy policy shifts, combined with that current value destruction evidenced by ROIC falling below WACC, well, that might just be too much risk to stomach.
So ultimately,
the decision really hinges on your individual assessment. How likely do you think a recovery in the residential solar market is, and how soon? And how much confidence do you have in this management team's ability to navigate a crisis that's largely driven by forces far beyond their direct control?
a tough call indeed. Well, if you found this deep dive helpful, please do like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, please do.
And remember, Stock Analytics AI members get priority access to deep dive suggestions. Just pop them in the comments. Join us for just €4.99 a month for insights tailored to your interests.
And just the standard reminder, This analysis was generated by an AI system. It's for educational purposes only and should definitely not be considered financial advice.
Absolutely. Please do your own research or consult with a qualified financial advisor before making any investment decisions.
Always good advice.
So, a final thought to leave you with as you consider Enphase's future. In an energy landscape that increasingly demands both clean power and grid resilience, how much value does that truly integrated, intelligent home energy management system command, even when it's facing such powerful short-term storms? Something to think about.